How do interest rates impact Black family wealth? Imagine trying to build a sturdy house without knowing if the ground beneath is stable. That's what understanding market cycles and interest rates is like for Black families working to grow their wealth. When interest rates go up or down, they influence how much it costs to borrow money, which affects everything from buying a home to investing for the future. When interest rates rise, borrowing becomes more expensive. For Black families, who often face higher borrowing costs and credit challenges, this can mean paying more on loans like mortgages, car loans, or credit cards. Higher payments can limit how much money is left to save or invest. If a family wants to buy a home, higher interest rates mean higher monthly mortgage payments, making homeownership less affordable. This can slow down wealth growth because owning property is a key way many families build wealth over time. Data shows that when interest rates increase, fewer Black families apply for mortgages, and more are denied. This is partly because higher rates push up debt-to-income ratios, making it harder to qualify. Even when they do qualify, Black borrowers often pay higher interest rates and fees than white borrowers. Over the life of a mortgage, this can add up to thousands of dollars more paid in interest, reducing overall wealth accumulation. Interest rate changes also influence how Black households spend money. When rates rise, they tend to cut back on everyday spending more than other groups. This can make it harder to save or invest, but they might still spend on durable goods like appliances or electronics. These spending habits are shaped by financial priorities and available cash flow. Understanding these market cycles helps Black families plan better. For example, they can focus on improving credit scores to qualify for lower interest rates, or look for community banks and credit unions that might offer more favorable lending terms. Budgeting for culturally significant expenses like family reunions becomes easier when knowing how interest rates impact cash flow. Advanced investing and diversification strategies also play a role. By spreading investments across different assets, families can reduce reliance on debt-sensitive assets and create multiple streams of income. This approach helps buffer against the effects of rising interest rates and keeps wealth building on track. In summary, rising interest rates can slow down Black family wealth growth by making borrowing more costly, limiting access to homeownership, and changing spending habits. Staying informed about market cycles and using smart financial strategies can help families navigate these changes and continue building lasting wealth.